Let's bring in our closing bell exchange to talk about this market, S&P and NASDAQ higher. Joining the exchange today, Doug Sandler from RiverFront Investment Group and Cassandra Toroian from Bell Rock Capital. Also, of course, joining us is Rick Santelli. You know, Doug, today's move is sort of emblematic of this entire bull market, which now reaches a record as of today in terms of the longest ever bull market in history. And that is, the defining feature has been resilience to the European debt crisis, to Brexit, to political surprises in this country. It doesn't appear that these political developments are any different. Is that what you would say? Is that how you would characterize it?
Yeah, well, I think the market ultimately looks at fundamentals, and fundamentals have remained strong and have actually been getting stronger lately. To the extent that the geopolitical stuff impacts that, then I think the market responds. I love the fact that the complacency that seemed to be seeping into the market in the first quarter has really been erased. And, you know, the enemy of a bull market is complacency. I don't think it's there. So ultimately, I don't want to be underweight stocks at this point in time.
Cassandra, we've spent a lot of time today talking about the strength of the consumer. I'm curious as to your thoughts, given what we've seen in retail and overall, what that will mean for the market.
Absolutely. We expected, given the strong underpinnings of the economy and the unemployment rate being so low, we've been expecting stronger retail earnings and consumer strength. Look at Target, look at Nordstrom's, look at Costco. Look, there's a number of very positive stories out there. And that just speaks well, I think, going into the Christmas season. And it tells us that some of those problematic retail stories are not systemic, but really a problem in and of themselves, like a Macy's. So you saw Kohl's again do well. So this is definitely a actually the CEO of Target said the strongest consumer economy they've seen in ever. So that is why, at least in our portfolios, we've been chipping away at these names for a few months now and adding more diversity and breadth to not only consumer staples but consumer cyclicals, because we do think even at the high end, look at Toll Brothers had a record quarter. These are all strong reasons why the market is going to continue higher.
Rick, we did see the dollar weaken. I mean, it's been weakening for a few days now, and it's coming off of that big overbought period. But do you think any of the political uncertainty is being reflected here?
I really don't. You know, we're at levels that we closed at on the 8th of August, so we'll call it 2-week lows, just slightly above 95 handle. You know, we fell from almost 97, which was close to an intraday high, never closed with a 97 handle. But do keep in mind, we're up just shy of 3%. We settled around 92. We're hovering at 95. We gave about 1.5% back. We were up almost 5% or so. But it's still a nice showing, especially considering how behind the 8 ball the dollar was. I mean, that's where it settled last year, but its first foray in the year was to trade lower. As far as interest rates, I think that's really a great story. You know, we're down 19 basis points from the high closing yield in August, early August. That's a lot, but it isn't only us. Canada's 10 years about the same, European 10 years about the same. These are all countries with very different underlying economic fundamentals. The UK's 10 years done the same thing. When you consider Canada, their yield curve's even flatter than us. They had no QE. They had no major crisis-era policy like a lot of other central banks. So this is a global dynamic, and it's something to pay attention to. And I don't think it's just as easy as saying, you know, the Fed is doing a good job in preventing any surprise inflation. There's a lot more at work here, and I really do think that the long-term implications of interest rates, with investors always seeming to find a place to hold these, and the big presence of institutional and non-institutional shorts, is going to make the long end continue to be a conundrum pretty much in every developed economy.